What's up, guys? I am going to be doing a market review for November 9th. What I'm going to try in this review is I'm going to try and play the live stream. So this morning's live stream was silent. And I'm going to try and play it and narrate over it. I'm going to play it at like 2 times the speed. And I might skip and scrub. So bear with me. I want to try this. I want to try this just because it'll be like reading price real time where you don't see the right edge, meaning you price is still printing. It's not like kind of hindsight. So we did trade live, but I just want to try this. Let me know if you think this is a really good idea, if you like this, because it kind of, especially for people that might not be able to watch the market and can only view it in hindsight, they can watch this video and they can, say just ignore they won't look at the charts and they can just go straight to this video. And it's almost like I'm reading it live with them because it's their first time seeing that price action. So I'm going to switch it to 2 times. I'm just going to see how this one goes tonight. I will start off by saying I want to address this London session. So I think it was yesterday's live stream. I talked about how there's different types of London sessions, and the London session that's the easiest to trade, it's my favorite opening of New York, is when it's just a corridor, when it's just, sideways. So you can see we ended the day, which was yesterday, Wednesday, November 8th, up here. And then in the London session, or after market trading kind of trailed down, London opened, or no, the Asian range opened, and then it kind of went Asian into London, just trailed sideways. This is the best London session in my opinion because the liquidity is so obvious. You either use the low, the overnight low, so right here, or you can use the overnight low and the overnight high, which in this case was like right there, but I put it right there because they were so close. Okay. Let's play this. It's 9:28. Market is about to open, and immediately what I'm watching, so I'll pause it. Immediately what I'm watching is we have this buy side and this sell side. What does it do? And how does it take either of these two levels? That is what I'm looking at. And I also was looking at the dollar and watching if it was going up or down. Okay. I wish this could go a little quicker. I don't know if I might be impatient. It's a 50-minute live stream. 2 times speed, it'll be 25 minutes. Okay. So we open, and you can see this aggressive push up. And right there. So if you struggle with the difference between identifying a market structure shift or a sweep of liquidity, so market structure shift is it's going to continue in that direction, or sweep of liquidity means it's sweeping liquidity at a high to then reverse. This right here is a good example. This is like a prime example. It's like normally they are hard to identify because what you'll do is you'll print a few candles up and it's kind of hard, but this is something where it's just so it fits the smart money concepts ICT theory so well. The theory that the wicks do the damage, the bodies tell the story. So look where we are on the 5-minute right here. We came up above these highs. If we didn't just print that wick right there and say it just dropped, I would have considered these highs. See these three on the 15-minute, 1, 2, 3. we could have broke structure there, and I would have said, okay, we just swept these highs, these London highs, and now we're going for sell side if we broke structure there. That would have been enough for me. But this was the previous day's high. So on the daily chart, this is a wick on the daily. It's the long-term high of this range. And did you watch how aggressively we just printed that wick above there? That was purely a liquidity grab. We wicked so hard above that and then just immediately drops down. Right there, that's when I knew. I was like, we're going to get a 2023 model and on this break of structure, and it's going to be great. So right here, I'm drawing out the opening range gap. So for the opening range gap, it's great for targeting. It's great for targeting purposes. So although we are right at the top of it, I would target like the consequent encroachment and the bottom of it. I think that's purely fair. Remember, this is a gap. So price will want to deliver sell side and buy side, and buy side and sell side depending on how you're opening up. And right there, this was the displacement. So at the time, I'm being patient because we haven't broken structure really yet on any 5-minute. We had that wick right up there, took that buy side. And we're breaking structure on the 1-minute, but again, I like 5-minute breaks in structure. They're just a lot, they confirm. And then look at that. That right there, that is great displacement. That is like you just took a higher time frame, meaning hourly, 4-hour daily high, and then you displace like that, breaking a 5-minute swing low. That's how you know right there. You can see me calling out the market structure shift. I'm getting ready to call out a fair value gap that's about to form. And right there, you can see it came up pretty aggressively. See this right here? The dollar. See the dollar? You can see the dollar going up. It already made a low, swing low, high, swing low, higher high, swing low. Now it's going up. So you have this low, high, low, high, low, high. That's enough for me. So it was, oh God, I just thought I could scrub. Thought this was the actual chart. So you can see in the morning it's going down, which makes sense because the market's going up. But right there, this is the dollar turning around, and it fits the context. Remember, narrative we're talking about. You have to build a narrative. The narrative is we just swept this higher time frame buy side liquidity to reverse, meaning the dollar is also now reversing, and it's showing proof of that. You had the market structure shift. Remember, this is at 2x speed. I fix it right there. Fixing the correct opening, 2022 model. And at that moment right there, so I wait for the opening range. I like to trade mostly the silver bullet in this channel. But I put the 2022 model is something that I put in there for myself for my own trading model. Like, this is how I trade. It's very easy. It's very consistent. I'm confident in it. And I put it through 9:30 to 10 just to give myself something that because I noticed the 2022 model forms often in this time, especially when you have a London session that goes sideways. So I gave this model for me almost in my early days so I wouldn't feel FOMO if I saw something play out and it's just like, okay, well, now I have FOMO going into 10 o'clock. So I gave myself the 2022 model in this very narrow range, and it's a very safe model. It's a very easy model. It doesn't happen all the time. If you notice, I don't trade it a lot on this channel. But when it is there, it's there, and it's great. So I sold right there at the market. Now what I was doing here with my stop was I put it above the mean threshold of this wick. To be honest, if we spent more time like in this fair value gap, I probably would have ended up putting it at that candle's high, but I thought the mean threshold of this wick was the absolute, or the consequent encroachment of this wick was the absolute, like if it goes and closes all the way up there, we aren't going short. So yeah, and I was lucky that I didn't really have to even think about that because I drew out our 40 and then we blew through it. So right there is a beautiful 2022 model. We have the opening range gap that we're targeting through it. I pointed out how we swept this higher time frame buy side liquidity, which is also all the London highs, and the market structure shift on the 5-minute formed a fair value gap, dollars rising. Beautiful. Now you can see me circling this low because now I'm about to draw it out, I believe. So I took the first 10 handles on NASDAQ because it's something I'm trying to preach in this YouTube channel. It will serve a really good point later on as we build this equity curve. I'm going to reflect on this process of always taking the first 10 handles later on in the channel. So just so you know. But when I do take those first 5 handles, I knew it was going to come for this low and then the London lows. And the context that I'm talking about that I'll talk about later is once we get the account out of drawdown, we're about to get it. I'll start using more than one contract. I sized down because we went on a little bit of a losing streak and it's smart to size down. I'll make a whole video about sizing down and coming out of losing streaks. But when we start using 2 contracts, we'll be entering 2 here, and then what we'll do is we'll take our first partial at 10 handles on NQ, and then that's when our equity curve is really going to start to go exponential because I'll be holding out for down here, and we're going to be catching like 50 handle, 30, 50 handle moves. So right there, what I'm calling out is the mean or the consequent encroachment of this up close candle. So up close, when you're in a sell program, up close candles are important. Up close candles in sell programs should act as resistance. That's something ICT himself has said. And I called out this wick because the body is so small. And wicks are PD arrays. The consequent encroachment of wicks are PD arrays. And you can see it displayed right here. We broke down lower, came back up, came down, broke down. Then this candle came right up to that consequent encroachment of the up close. I don't care too much about the consequent encroachment of the other ones. They are important, but I care more about the up close candle consequent encroachment. So look, right here you can already see we took that other swing low. So your 5-minute swing lows can be, profit targets if you're not too confident that it'll come down here. You can use this one, or that's the market structure shift. You can use this one. You can use this one. You can use that one. And at this point, the dollar, you can see it is kind of coming down, but I've already seen enough signatures in price to know, and I mean, it's easy to say because we got our 10 handles, but off of how price is delivering, I'm very confident that this is how, I've seen it enough times, this is how price should deliver in this 2022 model when seeking sell side. So right here, what I'm doing is I'm comparing the move on ES, if you notice, so I'm drawing it out right here. This fair value gap, this is that same, is it the same? It's not the same, but this is another fair value gap. It looks like it's a minute before the one we entered in on. ES never went back to it. You never got the entry on ES. And I play ES 99% of the time. But that is something that sometimes you have to deal with. You don't, a fair value gap might form on both ES and NASDAQ, and you don't get, only one of them actually delivers to it. So kind of pointing out the up close candles. They're pretty hard to see right here. Just being barely having any body. So right here, what I'm doing is I am drawing out our expected dealing range. It hasn't happened yet, but the projected dealing range, your best and safest entries are going to be in the upper 50%. As you can see, this fair value gap was, this entry off the consequent encroachment of that wick was, and then you can see how heavy it got after leaving that 50%. And you can see us delivering to these London lows. So what I'm saying right here is, the entry was where we entered, or the consequent encroachment of that up close candle. There isn't much in terms of inefficiencies here. So if we retraced, say, all the way up to this 2022 model, I would not try and enter again to go long, to go short. So we're so close to that sell side that the moves just about panned out in my mind. And what I was doing right there, I was just typing out, depending on if we got back to this fair value gap / how aggressively we retraced, I would have thought that, we were turning around if we didn't take the sell side. Because sometimes what it'll do, it'll save that sell side for later. This is just me calling out, because some people don't know what this yellow line is. And also, yeah. So right here, what I'm doing is I'm comparing the sell side on, or the breaks, like the sell side on the dollar and the sell side on NASDAQ. So these two markets should be inverse. So we don't want to see them both going down. And I'm pointing out the fact that the dollar is taking out some new lows. And I think that's kind of why I typed out this little blurb right here. Then I'm comparing the sell side to ES and NASDAQ, and see these lows, these London lows, especially this swing low. It took it on ES. So the markets weren't perfectly in sync over the London session and the New York range opening. But the fact that we took these lows on ES, if the dollar got really heavy, I would have it could have been allowable for NASDAQ to not need to take this sell side liquidity. And that's why, we're told not to trade when the markets are decoupled, because these markets should move in tandem and be making the same lows and highs. And if they are decoupled and, ES is taking liquidity to the downside, but NASDAQ isn't, well, maybe NASDAQ won't end up taking that liquidity and we reverse. So you might hold out for a target and then you get reversed on and stopped out. So that's why, you got to be nimble. That's why it's important to take partials. So right there, I'm calling out the SMT. Like right now, I think it's safe enough to call it an SMT divergence. But as you can see down here, these are the lows of the London session. They just didn't come down and make such an even low. Didn't retrace as much on ES in that session. And then watch. So notice how, remember what I said about the up close candles and a sell program up close candle should act as resistance. I know it's hard to see, but you have this up close doji candle right here. You can see us coming up to it, but the bodies of these candles, the bodies are respecting the consequent encroachment. If we were live on the chart right now, I'd draw the fib out and measure that for y'all. But the bodies, the wicks are coming up. But the bodies are staying under this body and this consequent encroachment. Okay. I kind of want to scrub just to like skip to a more significant. Oh, there I go. Yeah, so I got a little bit ahead of myself. There's me measuring out the consequent encroachment of that up close candle. You can see the bodies. I kind of want to scrub forward, but I also don't want to mess it up. The scrub can be pretty sensitive. It's kind of annoying. So that's me just drawing out like a possible scenario of, a reversal to the highs. I'm watching this dollar right here. I did that because I was watching the dollar make this lower low. So again, if the dollar is making a lower low, we shouldn't be expecting the indices to also be making a lower low. But sometimes you can catch an SMT divergence between the dollar, which is the benchmark, and the underlying asset, which is the indices that we are trading. And notice how we have these two candles that come up to the consequent encroachment, but the majority of these candle bodies are in the bottom quarter of that wick. That's good to see. So again, we're having this deeper retracement with the dollar making a lower low. This is me kind of typing out the bullish narrative that I thought might have happened. I thought we might have, like formed a swing high, came lower, and then broke that swing high. But So right here, I got pretty concerned because, as you can see, we have this high right here on NASDAQ, and we can see the 5-minute candle coming up pretty close to it, but that 5-minute candle is nowhere near it on ES. That was a red flag to me. That was like, that's not an SMT at that point. That's pretty close to a decoupling. Again, I talk about the concerning. I wouldn't want to see NASDAQ come up and make that higher high. Just to go lower. And really what I was thinking about this whole time, so as long as we were above this swing high right here, I wasn't really too convinced that we'd be going higher. That's what I was waiting to happen. So this low, high, lower low. Then we have this little high right here, but I think we really needed a deeper retracement if we wanted to go lower. I'm going to try and scrub a little, speed this up for y'all. So now what I was doing was I was trying to see if when ES took this sell side, did it take it so we could reverse and like print an up close candle on the day? So what I started to watch was the bullish PD arrays. I called out this order block. I called out the consequent encroachment of this wick, and I wanted to see which PD arrays were respected and which ones were violated. I guess I said mean threshold, but I've been mixing those two up a lot lately. The center of wicks are consequent encroachment, because wicks are gaps. Calling out the dropping dollar. You can see now we've delivered sell side to the range and buy side to the opening range gap. Okay, so the fact right there, the fact that we got over this wick and this just the bodies of this swing high, I really thought we should have went higher, like for the day, continuing. So you can see me draw out this breaker. It's also a breaker on the 5-minute. And then watch. So I typed out these in high probability conditions because look at this high we're making, and we're not even close to making it on ES. This is starting to show. What I started thinking now is we're in a decoupled market, because look at ES. Are you going to trade ES? Whereas it's not taking that high. Are you going to trade it short with this fair value gap? If you're only looking at ES right now, you're like, oh yeah, I'm entering this fair value gap short because we broke structure and to the downside. Meanwhile, NASDAQ is telling a completely different story. They should not be telling two different stories. If you're sitting here saying, well, longs look good on NASDAQ, but shorts look good on ES, that's probably low probability conditions to be traded in. So right here, I'm watching this order block, and I'm thinking, okay, well, NASDAQ is looking bullish. Is it going to respect these bullish PD arrays? So I'm measuring out the mean threshold of the order block. I labeled this an SMT. It's really a decoupling. It wasn't super appropriate to call it an SMT divergence, but I wanted to draw your attention to it. And you can see it came through and just violated the mean threshold of that order block. And that's when I knew. Because when you have price like this, I've just seen it enough times. When you come down low, high, lower, low, and then you take off, these should be breakaway gaps, and this should be an order block. It should not have come this low. So after that, I was like, okay, well, we're coming back for that sell side. As you can see on the 5 minute, the ES is now breaking that swing low. NASDAQ isn't. And boom, ripped right through that. But I don't know. I don't think any of that trading was like you couldn't have entered on that price swing up. I don't think there was any like anything that like your average normal ICT student should have entered on. And now that we made on the 5 minute this high low higher high break, now we have this breaker to the downside. If you like form like this pattern, low high lower low break, bullish breaker, high low higher high break, bearish breaker, like you just back to back do that, like it's sweeping liquidity on both sides. Like that is not a high probability market. This is me trying to see this as a silver bullet. Now I saw some people on trading Twitter, and I don't know if I'd call it FinTwit, but trading Twitter doesn't sound as good as FinTwit, but I think they're two different things. There were some people that were like taking these two fair value gaps short. Personally, I don't think that was a high probability trade entry. We just swept buy side, buy side to sell side to buy side to sell side. I don't think that is a very high probability, because look, and whatever you would have been entering on to enter into these two fair value gaps to go short is you could have had the exact inverse on these two fair value gaps long. It had the breaker structure. We have displacement. We have these two fair value gaps. Like, and look, it would have blown right through you. It's literally the same setup, just inverse. So I didn't think these were two high probability trades. I saw some people, and that's what you get when you get. I'm really starting to notice the difference in like live people that do stuff live and do stuff in hindsight, because like in hindsight, first you can easily probably Photoshop these buy things on there just for a picture, but then you can just like be entering and exiting trades, and like whatever one sticks to the wall is the one you post. Yeah, so I put the stop all the way up there because you definitely would have had to allow for this fair value gap to be entered in on. And what you'll see is later we do enter, and we actually entered into this small one up here. But I think that just goes to show that this is kind of like a seek and destroy condition, because I don't think it should have retraced that far. This is technically a balanced price range right here. It shouldn't have came back up through this to the top of this breaker this deep. That's just my opinion. You could have people out there that would argue, no, it can. I don't think these were high probability shorts. They did play out. But I just want to say that for you guys here, because I don't want anyone thinking like, oh, I saw this guy that went short over here, but like, what did he see? And like, I'm not that good yet. And it's like, no, don't think that you're not that good. See, what you should, what the goal should be is you should be seeing and then eventually entering in on the trades that everybody that trades smart money concepts sees. So I'm sure there's a lot of people that took that entry that I took, and if we all are taking the same entry, then we're all reading price the same way. Versus this is, I wouldn't have entered that. Again, I think somebody could have entered that and something stuck to the fan and it panned out, but I don't think seeing these as entries short. I mean, you can, like, I was definitely thinking of that when I was watching price, but it was nothing where I was like, this is the entry. This is a good entry. So I just don't want anyone getting caught up thinking like, why didn't I see that? So yeah, I type it out. And then technically we never came up past, so like, I think the price didn't do anything, and it's not super seek and destroy, just in the fact that we didn't come up and violate a high. But I think it was a little, maybe too deep of a retracement, maybe not. Maybe ICT will come on and be like, hey, no, that's kosher. He traded it today, but because we didn't take out this swing high, we were just making a higher high, and up close candles should act as resistance. But me personally, I already got my trade. I got mine. I think this one was way more obvious, way safer than this. What's about to happen here? Damn, did I? I thought the live stream was longer than this. I think the live stream was longer than this. It's about to end. No, maybe it was. No, I'm typing it out. Cool. So I'll go over and finish the market review on the charts. So we ended price right here. As you can see, we came up and tapped right into that fair value gap. Again, I won't sound like a broken record. I think these weren't super obvious and high probability trades, solely off the fact that this high, ES didn't make that high, and the fact that it did that and then came down and run sell stops again. It could have retraced and went higher. You don't know that. But okay, you know what? That could have been the silver bullet of the session. This could have also been the silver bullet. Cool. So yeah, we came down, as you can see, came down, and then kind of just retraced, came back up, made these equal highs right here. Coming into the 11 o'clock hour, made these equal highs after taking this sell side twice. So we have this 1, 2, 3 drives pattern, breaking structure on the 5 minute. We technically break structure here on the 5 minute too, but then, again, I don't think these were high probability conditions. So if you are saying like, I did not know what was going on today, I don't think you really should have. But you could have entered here. I might have entered here if I traded in this time. Came up, made this high, sweeping out these equal highs. We dropped on the 5 minute. You can see us. This is like a long-term high. 2 intermediate term highs next to it. Came up, down, retraced, retraced up to the 50% line, fair value gap in the 50%, plummeted at 1 o'clock, made a lunch low, and then I think that was a lunch high. And then in the afternoon, I was on. I kind of broke down. I did like shorts, and I did think this was kind of the time to enter. Honestly, right here, that would have been the entry I would have liked. We had the 3 drives, 1, 2, 3, 5 minute, could not close above 50% of the opening range gap. We delivered to consequent encroachment of this fair value gap, and then we broke structure on the 1 minute, entered in. I mean, after a drop like this, you have 3 drives pattern. I think the break in structure on the opening range gap, leaving it, breaking structure on the 1 minute would have been enough. Re-entering in, delivered. You can see fair value gap here. All these up close candles are supporting price. When they returns up, support, breaks down, comes up, support, breaks down. This was the silver bullet. I didn't enter it at that time because Jerome Powell started speaking at 2, and maybe if it entered this like right here, I would have taken it short, but I wasn't going to enter something right at 2, right when he starts talking, because they could have easily manually manipulated this thing to heck right on that candle, and I wasn't going to take that risk, because trading is all about mitigating risk. So I talked about how this orange area was throughout that live stream, I talked about how it was a daily fair value gap, and that could have been the target for the day. We came up, swept the daily highs, and then you come and find inefficiencies to the downside. And then once we took that, I wasn't really too interested in price because we reached the daily objective basically, and I knew it could go lower, but that was the most high probability draw on liquidity, so it could easily come into that and then reverse and wick out of it. I kind of say this, on Thursdays and Fridays a lot when we reach weekly objectives. Just don't trade like we reach the weekly objective. Like anything else isn't super high probability. The draw isn't super obvious. So that I use that same context talking about price here. Like we reached the daily objective. The draw, like the obvious draw, has been reached. So yeah. And then I think something about ES. Something on ES was happening at this moment. Oh, ES. ES was also reaching its daily fair value gap. So they were kind of doing the same thing over here. And then we came down and worked our way through the bottom of this. I think the fact that we closed this daily candle below this daily fair value gap, I am hesitant to go long Friday. I want to see what the London session offers. Do we kind of hang out above it on London and then New York Open, maybe sweep some London highs, tap into this breaking market structure, go down? That'd be using this as an inverse. That's a possibility. I'll have to see how the London session prints out. But again, the draws on liquidity today were kind of easy to frame, but the way the market delivered to it was pretty, especially on ES. What is it? There was one that's really significant. This high right here on ES, that's what it was. ES, look at that. Nasdaq came up, took both of these highs. ES didn't. So when I saw that going into the 2 p.m. session, I was also like, I don't need to trade this. Like, it's not printing the same highs and lows. We can watch, but that's a red flag. That's a red flag. Cool. If you guys really liked me kind of narrating over the live stream, let me know, because if that's the preference, if you like that way more than me just kind of starting from the beginning on the live charts, let me know and I'll try and do that more. But if you like the other one better, yeah, you want me to start on the charts and just not even play the live stream and narrate it live, just let me know that too.